The first $100,000 is often described as the hardest milestone in building wealth. Charlie Munger, Warren Buffett's longtime partner, famously put it bluntly, "It's extremely difficult, but absolutely necessary." He didn't soften the message or call it challenging or slow. He emphasized how grueling it feels. And he was right. Reaching your first six figures is widely considered the toughest financial hurdle you'll face. Progress at this stage feels painfully slow, almost like something isn't working. Many people give up before they ever reach it, not realizing that the rules of wealth building begin to shift dramatically once you cross that threshold. If you're starting from 10,000, 20,000, or even negative net worth, it can feel like you're constantly fighting uphill with no momentum. That frustration is normal, and it actually reflects the math behind compounding at low capital levels. In this breakdown, I want to explain why that feeling makes sense, what the numbers are really showing you, and, more importantly, why the journey from $100,000 to $1 million is often much easier than getting to the first $100,000. We'll look at the compounding snowball effect, the psychological traps that stop most investors early, and a practical path to building that first six-figure foundation so the rest of the journey becomes far more automatic. I'm Todd, and I go through the financial fine print so you don't have to. Let's break down the math behind why getting started feels so slow. When Munger made that comment in the 1990s, he wasn't suggesting that $100,000 is a life-changing fortune on its own. He wasn't talking about luxury or financial freedom at that point. He was pointing to something more fundamental, a tipping point in how money behaves. He famously stressed that you should do whatever it takes to reach $100,000. Cut expenses, stay disciplined, make sacrifices. The idea wasn't extremism for its own sake, but recognition that the early stage is where progress is hardest. Once you pass that point, the pressure shifts. You're no longer relying purely on effort because your capital begins to contribute meaningfully. The key distinction is this: before $100,000, you are the primary engine of growth. After $100,000, your money starts to share that role. Now, why does the 0 to 100,000 phase feel so slow? It comes down to scale. At small balances, your own savings overwhelm any investment returns. For example, if you invest $3,000 and earn a strong 10% return, that's just $300. It's objectively good performance, but it's not life-changing. You could achieve the same result just by cutting a handful of discretionary expenses in a month. At this stage, saving an extra dollar has more impact than optimizing returns by a few percentage points. Compounding is technically active, but it's too small to feel. That's why progress seems invisible, even when you're doing everything right. Bankrate has run scenarios that highlight just how slow the early phase of investing can feel. Picture this. You invest $6,000 per year, about $500 per month, and earn an average 7% annual return. After 5 years, you've put in $30,000 of your own money. Your portfolio grows to roughly $34,500. When you break that down, only about $4,500 comes from investment gains. In other words, the vast majority, around 85%, is simply your own contributions. After years of discipline and consistency, the market has only added a relatively small amount on top. This is the stage where many people lose confidence. They look at the account and feel like nothing meaningful is happening. From a behavioral standpoint, it can seem like the opportunity cost is too high. You could have spent that money on experiences or purchases and seen a more immediate payoff in quality of life. That comparison is one of the most common reasons people abandon long-term investing early. But mathematically, this is also the least informative stage of the journey. Early compounding is structurally muted Because the base capital is small, the system hasn't had enough time or scale to express exponential growth yet. The real shift happens when the portfolio reaches a larger base, around the six-figure mark. At that point, the same 7% return produces a very different outcome. For example, at $100,000 invested, a 7% return generates $7,000 in a single year. That amount is no longer trivial. For many people, it exceeds what they can save through labor alone in the same time frame. At that stage, the portfolio begins to function as an active contributor. It effectively behaves like an additional income source, one that operates continuously without effort, adding thousands of dollars annually simply because the base capital is large enough for compounding to matter. That's the structural transition people are pointing to when they talk about the $100,000 threshold. Not that life suddenly changes at that number, but that the balance between earned income and investment income starts to shift in a measurable way. Continuing the bank rate style scenario, the long-term effect becomes much clearer once compounding has enough time to scale. If you keep investing $6,000 per year and earn an average 7% return, after 20 years, you've contributed $120,000 of your own money. Your portfolio grows to roughly $245,000. At that point, more than $125,000 of the balance is pure investment growth. The structure of the account has fundamentally changed. Gains are no longer a minor supplement to your contributions. They are now larger than everything you personally put in. The crossover point typically occurs somewhere in the $100,000 to $200,000 range, depending on timing and market conditions. That's the point where annual investment gains begin to rival or exceed annual contributions. In practical terms, your capital starts to meaningfully self-fund its own growth. This is the snowball effect Munger was referring to. The idea is not that returns magically accelerate, but that the base they're applied to becomes large enough that identical percentage returns produce dramatically larger dollar outcomes. Early on, you are doing most of the work. You're pushing the snowball uphill, forcing it to move through consistent contributions. That's the first $100,000 phase. High effort, low visible payoff. Once the snowball has enough mass, inertia and compounding take over. Your role shifts from forcing growth to maintaining consistency and not interrupting the process. This is also why breakdowns like the $100,000 chunks model are useful psychologically. Even if you never increase your monthly contributions, each successive $100,000 tends to arrive faster because the portfolio itself is now generating a larger share of the next increment. The growth curve is not linear, it's progressively accelerating. In early years, it might take close to a decade to reach the first $100,000. The next $100,000 can arrive significantly faster, and the pattern continues as compounding dominates more of the total growth equation. That leads to a counterintuitive conclusion. While becoming a millionaire feels like the ultimate milestone, the hardest structural transition is actually much earlier. The gap between $0 and $100,000 is dominated by human effort, discipline, and time. The gap from $100,000 to $1 million is increasingly driven by math rather than behavior. That's the real shift Munger was pointing at. Not the number itself, but the change in what drives progress once you cross it. To reach your first six figures, the scale of what you're trying to do is extreme relative to where you start. If you begin with $1,000, you need a 100 times increase to get to $100,000. By contrast, moving from $100,000 to $1 million is a 10 times increase. The arithmetic alone makes the early phase disproportionately demanding, but the math is only part of the problem. The real difficulty is that the first phase sits at the intersection of financial constraint and psychological friction. Externally, This is often the period where income is lowest and fixed obligations are heaviest. Early career salaries, student debt, rent burdens, and general cost of living pressures mean that saving even a few $100s per month feels like a meaningful sacrifice. You're effectively reducing your current standard of living for a future outcome that doesn't yet feel tangible. At the same time, your investment account is too small for returns to register in a noticeable way, so the feedback loop is weak or invisible. Internally, there's another layer: identity. At the beginning, most people don't yet see themselves as investors. That creates mental narratives that reinforce inaction. Ideas like, "I'm not good with money," "this is too slow to matter," or "I'll start seriously when I earn more." These beliefs aren't mathematical, but they strongly influence behavior. This combination is what makes the first $100,000 phase feel uniquely difficult. You're operating in a 5 to 7 year window where discipline is doing almost all the work, while reinforcement is minimal. Gains are too small to feel rewarding, and the future payoff still feels abstract. What changes after that threshold is not just the portfolio size, but the feedback loop. You've now seen the system work over time. You've likely experienced volatility without abandoning the strategy. You've built consistency through repetition rather than motivation. So while the financial outcome is you are richer, the structural shift is more important. You become more resilient to uncertainty, more consistent under stress, and less likely to break behaviorally when markets or emotions fluctuate. That's the hidden transition people are really pointing to. Not just crossing a number, but becoming someone who can reliably compound capital over time. Recent financial commentators often refer to the $100,000 mark as a wealth acceleration point, the stage where the mechanics of growth begin to shift from primarily savings-driven to increasingly compounding-driven. One common argument is that the first $100,000 is not just a milestone, but a filtering mechanism. A large portion of people never reach it, often because they are operating in a paycheck-to-paycheck framework where consistent surplus cash flow is limited. Crossing that threshold, therefore, is less about absolute wealth and more about demonstrating sustained financial discipline over time. At that point, the system starts to behave differently. Momentum begins to build, and compounding becomes more visible. From a practical standpoint, the key insight is that the early accumulation phase is dominated far more by contributions than investment performance. In the first several years, differences in return rates, for example 5% versus 10%, have relatively limited impact on the timeline to $100,000 compared to one dominant variable: how much you consistently invest. That leads to an important implication. This phase is fundamentally savings-led rather than return-led. When capital is small, there is no meaningful advantage to complex optimization strategies like stock picking, market timing, or chasing high volatility bets. The portfolio simply isn't large enough for those decisions to matter in a measurable way. Instead, progress is driven by three core inputs: savings rate, how much you consistently invest; income level, how much surplus cash flow you can generate; avoidance of high interest or lifestyle expanding debt. In this framework, optimization is often a distraction. The limiting factor is not sophistication, but consistency and volume of contributions. A higher savings rate mechanically outperforms marginal gains from better asset selection when starting capital is small. The implication is straightforward but uncomfortable. Early wealth building is intentionally unglamorous. It prioritizes discipline over strategy complexity. You're effectively building a system where the primary lever is how much you can reliably feed into the portfolio, not how cleverly you manage it. Only after the base capital becomes large enough does optimization begin to matter in a meaningful way. Until then, the dominant variable remains simple: steady contributions over time. That objection comes up a lot, and it's partially valid. But it also misses what Munger was actually pointing at. Yes, $100,000 in 1990 is not the same as $100,000 today in purchasing power. Inflation matters, but the underlying concept was never about the absolute value of $100,000 as a lifestyle milestone. It was about a mathematical inflection point in compounding behavior. Even if you adjust for inflation and say the modern equivalent is higher, $150,000, $200,000, or more, depending on assumptions, the structural argument doesn't change. Below that threshold, growth is overwhelmingly contribution-driven. Above it, investment returns begin to meaningfully compete with or exceed annual savings. That relationship is scale-dependent, not price-level dependent. So the core idea survives inflation completely intact. Where the criticism gets overstated is in treating the number as the thesis instead of the mechanism. The mechanism is early-stage wealth is linear, driven by input. Later-stage wealth becomes nonlinear, driven by compounding on a larger base. That transition point will move over time with wages, inflation, and savings rates, but it does not disappear. On the "this advice is outdated" argument, there's also a behavioral reality that still holds strongly today. Most people don't fail because they picked the wrong ETF or didn't find the right strategy. They fail because they never sustain a high enough savings rate long enough for compounding to matter. And that ties directly into the temporary extremity point you're making. Framed properly, the useful version of that idea is not deprivation for its own sake. It's time-bounded intensity, increasing savings rate early enough to compress the duration of the low feedback phase where motivation is weakest. That's why the distinction between lifestyle optimization and lifestyle anchoring matters. People who accelerate this phase usually do exactly what you outlined. They increase income early rather than relying on market returns. They avoid locking in permanent fixed cost inflation when income rises. And they route irregular income into assets instead of consumption. None of that requires permanent austerity. It requires preventing early lifestyle expansion from consuming future compounding capacity. So yes, $100,000 is not a magical number anymore in nominal terms, but as a model for understanding how compounding starts to dominate behaviorally and mathematically, the concept still maps cleanly. The threshold just shifts with economic conditions. The shape of the curve does not. You're partly correct, but mostly off. The exact figure has shifted. When adjusted for inflation, Munger's 100,000 is likely closer to 200,000 to 250,000 today. But the underlying idea remains unchanged. It's timeless. The math hasn't changed. Whether the number is 50,000, 100,000, or 200,000, the curve behaves the same. The hardest capital to accumulate is always the first meaningful amount, because it depends entirely on your own effort. You can define that threshold based on your own cost of living. For some people, the snowball effect might begin at 50,000. The exact number isn't the point. What matters is reaching the point where your money starts generating more momentum than your labor. Don't use inflation as a reason to delay starting. If the goalpost has moved farther away, that's not a signal to wait. It's a reason to begin sooner. To summarize this idea, it helps to think of wealth building in 3 stages. Phase 1 is the muscle building phase, from 0 to 100,000. Returns don't matter much in this early stage. The real work is developing financial discipline, learning to budget, resisting lifestyle inflation, and actively increasing your income. It should feel disproportionately difficult. That's expected and normal. Phase 2 is the snowball stage, roughly 100,000 to 500,000. At this point, compounding starts to become noticeable. The key here is simply staying invested and not disrupting the system you've built. Phase 3 is acceleration, anything above 500,000. In this range, Portfolio fluctuations can easily move by tens of thousands in a single day. This is where you've effectively earned the flexibility to rebalance your attention between your finances and your lifestyle. If you're still in phase 1, it's important not to be discouraged by slow, visible progress. You're laying the foundation for something much larger. The early milestones, 10,000, then 20,000, aren't insignificant. They're part of the necessary training period. Reaching 100,000 changes the structure of the game. It becomes the threshold where money begins to function more as a tool than something you constantly have to fight for. Munger was right about one thing. It is a difficult milestone, but it's also one of the most important you'll ever reach. I'd be curious to know where you place yourself on this curve. Still building the foundation in the snowball phase? Or already in acceleration? And if you've passed 100,000, whether you notice that shift where compounding starts to feel like it's working with you rather than against you,